we're looking at corporate profits because, of course, we have seen the beginnings of a large decline. But it really, I think we shouldn't get too hooked on what the precise magnitude of the drop that we see, pre-COVID-19 and what happens over the following 6 months. It's more a question of how long it takes to catch up. And so we'll be looking at that trajectory of recovery and then working through whether it is a kind of 2-3 year process or whether, miraculously we can kind of recover the lost ground in a year. I would say the market playbook currently is working along the lines of something that puts the clock right back in about 12 months' time. But I think that is probably extreme because these economic and profits conditions don't lend themselves to that sort of return, corporate profits return profile. And the key problem for us is actually further out because it just seems to us as though even if we allowed for that kind of V-shaped recovery, a lot of the drivers of corporate profits are actually missing in the post-COVID-19 world. And that's where I think that the real trouble begins because as asset allocators, as we look ahead to those return prospects, many of those profits drivers, particularly profit margins, which we know are at multi-decade highs, those look likely to be unseated in this COVID-19 and post-COVID-19 environment.
But Tapan, isn't the problem here that we need to be much more differentiating? We can't just say when will the market and earnings come back to a point that we recall before the pandemic? Because when you drill into the sectors here, financials, industrials, energy, they all look like they're going to take a lot longer than those sectors that have done better, like tech and healthcare, where the impact has been less severe. So as we think about how we allocate into the second half of the year, isn't it clear now that there are some winners and some losers, and those winners will remain winners for longer?
Well, I think there is something to what you say, but the differentiation, though, has become extreme because the winners that investors and the market are chasing are narrowing, perceptibly week on week, and a narrow market with fairly limited breadth in terms of what investors really want is not a healthy market sign. And I think it presages more volatility and potentially weakness ahead. So the bumps and slumps will potentially have to come because the market cannot be as differentiated, as you say, in terms of continuing that trend. Because the last 3 months has already been extreme in terms of that sector dispersion. And if you look within sectors, you see huge amounts of valuation dispersion. So even within sectors, markets have chased a smaller and smaller group of winners whose valuations have rebounded very substantially, while others have been left behind. And that trend is kind of market-wide. It goes beyond sector. So it suggests to us that essentially it picks up in the way that a number of other indicators we look at pick up, suggests a high degree of unease underneath what looks like a nice V-shaped recovery. And one of the things is the way dividend futures are behaving. Because why? Why would, when the S&P 500 is, within shouting distance of its kind of February-March high, why is it that dividend futures are saying the dividends will take 3 or 4 years at least to catch up with 2019 levels?
Tapan?
Why is it saying that? Because I think there is a realization that the new normal post-COVID world will look very different and potentially hurt profits and profit margins. And that is going to be potentially multi-sector, not just the one or two sectors that are most affected.